Hello ladies and gentlemen, welcome back to another episode on this public investment portfolio playlist. If you follow this channel for quite some time, you know that I have this public investment portfolio where each month I show you with which positions, which stocks I'm investing. And full disclaimer right here, this is not any type of financial advice. I just do me, you do you. Just because an investment might make sense for me, it might necessarily be the best one for you. I do this for entertaining purposes so that in a few years I can look back and understand, oh, this was a good decision, this was not such a great decision. Maybe I'll look back and say, oh, I was in this stage of my life. Oh, I thought this company is going to exist and do this in the future. Maybe they didn't, maybe they did. Maybe this portfolio will be great, maybe it will be terrible. I don't know if I'll keep making these videos. There is a lot of uncertain variables right here, and don't trust a random guy here on YouTube. So this episode is gonna be a bit different because, okay, today is a Friday, I just came off work, I was a bit tired and I already recorded this video, but I forgot to be screen recording on my phone. So as you can see here, the portfolio already looks a bit different than the previous episode because I already invested in the pie of today. And not all orders have executed, so I contributed 120 euros for this month. And sorry if I'm going extremely fast, but if people follow this channel, you already know what I'm talking about. And since these videos don't get many views and I will be rewatching them when I'm older, this is just a time capsule thingy. So most of it is going to the S&P 500 ETF and the Information Technology Exchange Traded Fund. So this is a basket of stocks, and as you can see here, 30% is going for one, 20% for other, and 10% for all world ETFs. So 60% of this contribution this month is going to a basket of stocks. So I would say this is a pretty conservative approach from my side. And then I have more aggressive plays, like 15% on Disney, that's been a bit down, then some exposure to Chinese stocks, and 4%, just a really symbolic amount, to a Portuguese company called Farfetch. Why I'm investing in these companies? Well, you can see here in my portfolio that Alibaba is not trading that high. Farfetch is down like 50%. It was 50% my position, and I don't want this to be an overwhelming position in the entirety of the portfolio. That's why I'm only contributing a bit to average down my price. Maybe this company won't even exist in a couple of years, but I guess only time will tell. JD.com is, as a performance, a terrible performance so far, 10% down. And you can see Walt Disney is also 2%. These orders already executed, so this is not as bad as it was when I was supposed to be recording. So the total portfolio right now is 1,867 euros. We have a performance year to date, or no, not year to date actually, from inception all the way here of 11.80%. So it was 12% before I started investing on this contribution today. So if I were to retire today, I would have 12% on my money, which is not bad, not amazing. Either way, if you follow these episodes for quite some time, you know that sometimes when I open this, it's in the red, others in the green, but we have a long-term horizon. Maybe this will be like a second retirement for me, so I'm really not stressed about this. Right now, if I were to say to myself, okay, I'm gonna invest 1,800 euros, probably I couldn't, or that would be a really terrible financial burden for me. But if you do it consistently over a longer period of time, in this case almost 2 years, it makes you more at ease with this, and it's not as emotional stressing as investing a big lump sum today and tomorrow is down 5%. You'll be thinking that you're an idiot, and this is all about making your life better, and adding that extra layer of stress probably is not healthy. But well, that's my take on investing. Maybe you have a different approach, maybe you have a higher risk tolerance, a higher risk profile, or maybe you have a better emotional tolerance than me. Either way, everyone is different, everyone has their own rules. And if you can see here from the history of the pies that we've created over this series, if I had invested all my money in the pie that I created in January of 2022, which was looking more or less like this, we would be down 1%. But if I had invested all my money, for example, in December of that same year of 2022, I would have a return of 35%. As you can see here, Google was trading pretty down. Meta as well, so I had a return of 171%. Farfetch was down. I invested in Farfetch actually here. That's curious. And I would be down 60% if I had invested all my money on that position. But the entirety of the portfolio would be up 35%. But this is the way it goes. Sometimes I'll be investing when the market is at all-time highs. Other times I'll be investing when it's all-time lows. Of course, sometimes I will have better timing. Others I will have the worst timing. But hopefully in the future, in the long term it will average out and we will be in a better position than we started, or maybe not. I guess you'll have to stick around to see these episodes, or maybe I also need to stick and keep making them. So thank you all for watching. I'll see you in the next video. Bye.